Hello and welcome to the latest Insider interview. Our guest today is Ian Lance, who is the co-manager of the Temple Bar Investment Trust. Ian, thank you very much for coming into the studio.
Pleasure.
You've got 70% invested in the UK. Is that high or low by historical standards?
The trust has to be 70% invested in the UK, and at the moment we are just over that. So, but historically, it has been higher. So I suppose you could flip that round and say actually we are utilising nearly all of the 30% to invest overseas that we're allowed.
And of that 70% then, where are the best value opportunities today then in the UK?
We're still seeing a lot of value within financials, despite the fact that financials perform quite well. So banks, insurance companies. Then there are some specific companies where we think that what we can see is effectively a turnaround. Where you've had a company which has been struggling historically, often there'll be management change, and the new management team have got a strategy to basically improve earnings, and we think the earnings will go up and the share price will follow. So examples of that might be Marks and Spencers would be one. Smith and Nephew is another one. New management team with a 12-point plan to turn that around. Johnson Matthey is another company where the management team are basically selling businesses to realise value. So lots of specific companies as well.
And the UK market as a whole has generally been ignored by international investors. There have been lots of good value opportunities there.
Yeah.
So why do you think that is? Why is the UK such a good hunting ground if you're looking for cheap shares?
It's a good hunting ground, I think, because it has been ignored. Some of this has been, you're absolutely right, international investors. Unfortunately, some of it has been our own investors. So, back in the 90s, when I was a pension fund manager, the average pension fund would have over 50% invested in UK equities. Today, that figure is probably something like 3%. So, we've seen sort of 20 years of selling of UK equities. Irrespective of valuation. And what that's caused is that lots of big wealth managers these days will benchmark themselves off global indices. And when they look at a global index, they'll see that the UK is weighted at 3%, and the US is weighted at 70%. Now, for most of the people watching this, that shouldn't really matter to them. What should matter to them should be, where can I make money? And the UK is offering, we think, very attractive opportunity because it's very undervalued. And it's very undervalued because lots of people have been selling it. I guess the final thing I would say is, when you've got to 3%, you're probably close to the bottom in terms of people taking money out of the UK. And anecdotally, actually, we are starting to hear about overseas investors starting to put money back into the UK, attracted by the low levels of valuation.
And do you think that'll be a catalyst for higher share prices in the UK?
Yeah, I do. I mean, so that's one. We're hearing about overseas investors putting money into the UK. I think the two other clear catalysts were takeovers. So UK companies just got so cheap last year that lots of overseas companies were able to buy some very cheap businesses in what was probably a cheap currency. And so, within Temple Bar, we had 4 takeovers last year, 2 of which went through, 2 of which didn't. But even the ones that didn't, so Currys was bid for at the start of last year at about 60p. The share price today is 120. So takeovers was one catalyst. And then the other one has been companies buying back their own shares. So this has been a big driver of the performance of the banks. Companies like NatWest and Barclays have bought back a lot of their own stock at very low levels. So they've effectively been creating their own demand for their shares. And when you're buying back very lowly valued shares, that's very positive for your earnings. So, yeah, there are definitely some interesting catalysts now.
And can the UK market continue to recover? As you said, it's done very well recently. Is there more growth ahead?
It looks like it. I think people must try not to anchor off low valuations. We have a chart of UK valuations that actually goes back 50 years. Well, last year we were close to a 50-year low in that chart. And therefore, the fact that you tick up from that 50-year low doesn't make shares expensive. It just means that they're not quite so cheap as they were. And I think, there's potentially still a long way to go if you correct some of that discount.
And when you look at the UK equity market, how much attention do you pay to the economy? All we hear is bad news about inflation and growth and government's difficulties controlling the deficit. What does that mean for the stock market?
Probably not a lot, actually, which might surprise some people that I say that, because I think people probably think that the stock market and the economy go hand in hand. Of course, that's not really the case for a couple of reasons. Number one is because the stock market is a discounting mechanism, so the stock market is looking ahead, not back. So the stock market, probably knows and prices in all the sort of bearish news on the economy that we're hearing today. So that's point number one. Point number two is you've got to realise that lots of the stocks in the UK stock market are not that exposed to the UK economy. A lot of them are big, international businesses that happen to be quoted in London. And so, even if the UK economy doesn't do very well, for a lot of them, it's not really that important because it's just such a small part of their profits.
Moving away from the UK now, where is that remaining 30% invested?
It's a range of companies. So we have some European investments, we have some Japanese investments. I think a new area that we've invested in, which I think is quite interesting, is Korea. So Korea is a market that has done quite badly for quite a long period of time. Valuations look very low. And it's one of these areas that the story is somewhat similar to Japan a couple of years ago. In other words, you have a government now that has a clear policy to try to encourage companies to create value and to basically remove some of the low discounts that they're trading at. So that is a positive catalyst. And we recently for Temple Bar bought two Korean banks called Hana and Woori. These are very, very high quality banks. Actually, the Korean economy is doing very well. The South Korean economy is doing probably a lot better than the British economy. And yet they are trading at very, very low valuations. They have very good policies in terms of returning money to shareholders. So we thought it was a really interesting area actually outside of the UK.
And what about the US? Just how expensive is that market? And are there opportunities there for value investors like yourself?
No, there are some opportunities because the US is a big market, and I think a big part of the overvaluation comes from the fact that as I guess probably everyone knows, 30% of the US market is in seven technology stocks. Those seven technology stocks are probably quite expensive. But outside of that, there are definitely some cheap stocks in unfashionable areas. Overall, though, I think people should be cautious having too much money invested in the US market. I was looking at a chart yesterday done by a US fund manager called John Hussman, and he has a market cap to GDP type ratio, which goes back 100 years. The US market has never been more expensive on that ratio, going back 100 years. And historically, when you've bought the market on that sort of return, you have lost money on an annualized basis of about 6% for the next 12 years. So if the data holds in the future, you wouldn't really want to have too much money in a US tracker. Let's put it that way. I think, as I say, there are pockets of the US market. Small cap and mid cap US stocks, there's probably plenty of value to go in that sort of area. But at the index level, I think it probably is pretty expensive.
As you said, it's these large technology stocks which have pulled up valuations and they dominate the indices. Are you worried about a bubble in AI? It's all we seem to hear about at the moment. Does that worry you a little bit?
Yeah, it does. It does. I have been, believe it or not, I've been managing money for about 35 years. Therefore, I was managing money in the late 90s. And a lot of what is going on today is eerily reminiscent of what was going on there. What was going on back then was the fact that, obviously companies were beginning to use the internet, people were putting the .com label on stocks. And probably like AI, we all know now, don't we, that the internet, it was a game changer. It really, really changed the way that we all do business and the way that we all interact and read the news and everything. That didn't change the fact that some of the stocks involved in it were horrific investments. I mean, the NASDAQ lost 78% of its value in 2 years after 2000. Some of those stocks, it took 12, 15, even 20 years to get back to your start point. I have a horrible feeling that AI might be the same. In other words, yes, it absolutely is going to be a game changer in terms of companies' efficiency and how we all go about our business. But I suspect that is factored into a lot of these share prices and more. And that actually, in the long run, some of them can end up being very poor investments.
And following value investment strategy focused on the UK should insulate you if there is a big crash in that part of the investment world?
It should do, shouldn't it? I think sensible diversification is always, a good policy in terms of thinking about your investments. And for me, having 70% in the US doesn't sound sensible, particularly at a point when the US is very, very highly valued. And therefore, just almost from a diversification point of view, you can make the case, can't you, that you probably should be spreading your investments more towards UK, Europe, Japan, even emerging markets, etc. But especially so given the divergence in valuations. You're effectively switching from a very expensive US market into quite cheap assets in other geographies.
And finally, the question we ask all of our guests: do you personally invest in the trust?
I do, and so does Nick, and quite a pretty substantial amount of money. Yeah.
Ian, thanks very much for coming into the studio.
Pleasure.
And that's all we've got time for today. You can watch more of our insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.